So we've covered multiple videos on the Federal Reserve's monetary policies in the last year or so. We've covered inflation, stagflation. We've covered the Federal Reserve's objectives on this channel multiple times. We also drop pretty up-to-date videos when the Federal Reserve meets and, on their FOMC meetings. What I want to cover in this video is the positive side of what the Federal Reserve is trying to accomplish and where you can be putting your money that the Federal Reserve is trying to steer you to for now in this economic cycle that we're in. It's not all dark, it's not all doom and gloom, and I'm going to tell you exactly where and why you need to be in certain financial products in this video. This is JP from Blueprint for Prosperity. To all my pioneers, welcome back. To all my new viewers, welcome in. If you're looking to advance your finances and increase your net worth through mastering this financial system that we're in, with an emphasis on relationship banking, the maximizing of your borrowing capacity, the proper use of life insurance, and the ownership of real estate, then welcome home. You're in the right place. I promise to give you quality content that you can use, that is inspiring, will put you on the right track. So other than that, we're going to get right into it. So the Federal Reserve is fighting inflation at this time as its primary objective. It is not focused on trying to stabilize or increase the economy. Is actually trying to slow down the velocity of money in the economy. It's trying to slow it down. It's trying to take money out of circulation. It's trying to make it harder for you to borrow money, or by making it more expensive. They're trying to make it harder for you to spend by reducing wage growth and even, unfortunately, increasing unemployment. They're literally trying to cool down the economy by reducing the money flowing through the economy. That is the fight against inflation. Hopefully that makes sense so far. So where does that translate to where you need to be if that's the case? Because many of you are sitting on pretty reasonable cash reserves. You might have 4, 5, 6 figures and you're not really sure where to go. You're not really too hot on the investing thing at the moment because real estate is a bit of a mess right now and the stock market is a mess right now. Crypto is always a mess. So you're not really sure where to invest. You're not really sure where to put your money, but you have enough common sense to know I can't leave it in my, DOA, dead on arrival, basic savings account at whatever such and such institution. The Federal Reserve is trying to incentivize you to financially gain in one particular area. For the first time in a very long time, savers are being rewarded in this current economic cycle. What I'm saying is that the Federal Reserve thus is trying to, push up unemployment, stop wage growth, suck money out of the economy, make lending tougher. It's trying to do all these things. But the one thing it is doing to the good by raising interest rates and pulling other levers is actually boosting deposit account rates. CDs, high yield CDs in particular, savings, high yield savings and CDs are very attractive right now in comparison to the grander scheme of the economic cycle we're in. They're not the best place in the world overall. At the time of this recording, it is the end of May of 2023. CDs and high yield savings accounts are brilliant places for your money to be. Earning 3.5%, 4%, 4.5%, 5+, some cases 5.5% on your money when when headline inflation is at around 5%. It's not, core, it's not specific inflation on food and gas. Literally focusing on an overall accumulative basket that makes up headline inflation. It's hovering around the 5% mark. You can get a deposit product risk-free. We're talking about FDIC insured up to $250 and not in the investment markets, in any investment market. And you can get pretty competitive, if not a dead even interest rate with inflation, headline inflation. Mind you, you're not beating inflation, but you can take completely risk-free your money and actually keep up with inflation for the first time. That's very rewarding for you as a saver. For those of you sitting on cash that don't see a great opening in any of the investment markets, this is where you need to be. The Federal Reserve is actually trying to entice you indirectly to go in that direction. Why? because it actually is exactly what the Federal Reserve is trying to accomplish. It is taking money out of the circulation of the economy. Think about it. The Federal Reserve, if you're not spending that money, and believe it or not, even investing that money, two things that actually bump up or heat up inflation, because you're putting money in circulation. If your money is going into an investment, then that ultimately is pushing up the valuation of that investment. If you're buying stuff, you're supporting companies and putting money in circulation. If you're saving, that money's parked. Think about it. That money's parked. The Federal Reserve likes that right now. That's a good thing. They're sitting up there saying, listen, we don't need as much money in circulation. Now, we don't want the economy to crash, but we're willing to let it take a hit to get inflation down, because I've already shot a video. If they don't get this right, then we're going to have what's called stagflation, an utter nightmare. Check out that video. So the Federal Reserve wants you to save. High yield savings accounts, CDs, relatively to completely liquid. Shorter terms, if you're going to do CDs, nothing more than a year, because we can look up in a year from now, by next summer of 2024, and interest rates could be taking a nosedive. And you don't want your money locked up in a CD when the stock market or real estate's going through the roof again. So right now, I would do anything from 3 to 12 months on a CD, in my personal opinion, because you can get the best rates there. You will notice that banks actually have their best interest rates on about those terms. Why is that? I actually had a client ask me that today. And I told him, I said, my theory is that banks are confident that things are going to change. They don't want to be locked into paying people 4, 5, and 6% on CDs 3, 4, 5 years from now, 6 years from now, and rates are down again to 2 or 3% or lower. They don't want to be in that position too often. So their best specials, not that you can't get 3 or 4 or 5% on a longer CD, but their best specials are typically 2 years and less, 1 year and less, because they don't want to get too locked into paying you these high interest rates on these CDs. And meanwhile, their loan rates are less than that. They're paying you 6% on a CD, but mortgage rates are back down to 4 or 4.5. That's not what a bank wants to be doing, especially long term. So high yield savings accounts and CDs between about 3 months, year, maybe 15 months is a good sweet spot right now, where you can get pretty good, solid inflation, risk-free for the most part, and not have to risk it in the investment markets and still keep up with inflation, if not match inflation, roughly overall. It's a really good place to be. The Federal Reserve is trying to push you in that direction. I advise you take that advice and weigh your options out. If you're sitting on cash, you do not have a direct investment strategy for the next 6 to 12 months, 15 months, this is probably where you need to consider being. So to all my pioneers out there, thank you for tuning in. I know this was valuable for you. I enjoy bringing you the content as always. I want y'all to stay focused, stay in motion. I'll see y'all soon. By the way, links in the description for you to support this channel before we get out of here. It's your opportunity without spending a dime for you to go down there and get some great welcome bonuses and some great referral links for some great credit cards down in the description. It's just a few of my favorites, but they're down there in the description. You can shop any card that matches you, not just the ones that are linked down there below once you get inside that link, but it's an opportunity for you to get great bonuses while I get this channel gets the support that it deserves, putting out great content without you having to spend a dime. So for those of you who decide to do so, thank you. Thank you for your viewership. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.